Hello. Hello.
Hello, sir.
Yeah. Good evening. I hope everybody is doing well. And welcome to the live Q&A session. And we are looking at financial reporting, corporate reporting. We are also live on YouTube. So for those of you joining us on YouTube, you're welcome. If there are any questions, be specific as much as possible. We are not here to do entire topic, entire thing. It's a Q&A session so that we can, address people's issue specifically. So specific questions, specific issues, you can hop up. For those of you on Zoom with us, you raise your hand, we bring you up. Or if your background is noisy, you can put it in the chat for me and I will read it and provide you with some answers as specific as possible, okay? You have to be specific. What is the real issue? You raise it up and then we talk about it, all right? Then for those of you joining us on YouTube also, you can put your question in the chat for me and I'm going to be providing with some reply here. So it's a live Q&A session. Whatever questions you have, you raise your hand, we bring you up, or you can put it in the chat for me as we get into the discussion. Adongo, if you are on, you can unmute and bring up your question. I think there was a question you asked me on WhatsApp and I said I didn't get a context well. So
Okay,
if you
sir.
can bring it up.
I was asking of goodwill, how to deal with it in a situation whereby you have a subsidiary and a sub-subsidiary. In a situation whereby the main subsidiary is having a goodwill and the sub-subsidiary is having a gain on bargain purchase. In that situation, are you supposed to offset it from the goodwill?
Hey.
Or you treat them differently? Because I saw it somewhere that the treatment, there's a total, normally the total goodwill, they combine them. So once the other one is negative, they offset it from the main goodwill. So
no,
I wanted to find the correct one for our.
Okay. So when there is negative goodwill, it is an income on the acquisition. For that reason, the negative goodwill is going to be, how do we call it, put into the group retained earnings if you are preparing the consolidated statement of financial position, or it will be brought on the face of the income statement if you are preparing the statement of profit or loss. That is the consolidated statement of profit or loss. So we cannot offset. It has to be treated separately or individually.
Okay.
All right. Okay, so any other questions, please? You raise your hand, we bring you up, or you put it in the chat for me. Then those of you joining us on YouTube also, you can put your question in the comment box. Love your country said hi, say hello, love your country. 360 Wave said hello, hi. Sam said hi. Joe Mensa said hi, say hello, Joe Mensa. Good evening. Okay, so welcome. Any questions, you put it in the chat for me or you put it in the comment section. Or for those of you on Zoom, you raise your hand and we bring you up. Yes, Timothy, what you got?
Sir, good evening.
Good evening.
Please, so how to calculate the income to be paid during the cash flow?
How to calculate?
Like I was going through the note, but interest paid in the cash flow.
Okay.
That's one. I have like 4. I've written them down, but I'll get my books for them.
So let me bring up my screen and share my slide so I can write your answer down. YouTube, I see you guys joining. Give us a thumbs up on the video and also put your questions up for me in the chat. I'm going to be answering all your questions as we get excited on this Q&A. Let your question be specific enough so I can assist you better. Okay, so let's see what we got. Good. Okay, so interest calculation in cash flow. What we mentioned is that if you go to the statement of financial position and there is accrual of interest on the face of the statement of financial position under current liabilities, that means you have to prepare the interest account. Okay, you need to prepare the interest account. And so the accrual is a liability, has a credit balance. So you're going to be bringing the last year figure up. That's the opening balance. You close it up and you bring the current year figure up. Then you go to the P&L accounts and you bring in the charge for the year, which is what you added up in the adjustment earlier. Okay, you know, we will add back the finance cost for the year to come and calculate the finance cost that we paid for the year. So what you added up when you were looking at the adjustment is going to be brought here. Then suddenly you balance it up for the period under review, and then the balancing figure becomes the interest paid. So you do this workings if there is interest owings on the face of the statement of financial position. If not, then the interest paid for the year is the same as the interest charge for the year, which you added earlier, will be the same as the interest paid for the year, which is what you bring later on at the bottom. So that is how we calculate interest when we are dealing with a cash flow.
Okay. Thank you so much.
Right. What else did you say you had? Let's see if I can take one more. Okay, so Adongo, you can come up. Your hand is up.
Okay, sir. Also concerning a profit from a foreign subsidiary, I want to know the specific rate that we use. Sometimes they use average, sometimes it differs. So I just want to know the correct rate I should use.
Now, we made mention of the fact that when we come to foreign subsidiary, there are a couple of exchange rates that the examiner is going to be throwing at you. Let me just bring up, there are 4 or 5 exchange rate that the examiner will throw at you. So it is important you know which exchange rates to use. Let me see if I can just grab that slide and then show it to you from our previous discussion when we did this one. Oscar Group. So we will be giving exchange rate at the beginning of the year or the date of acquisition, exchange rate at the closing. Then we should know how we will pick those exchange rates. Foreign subsidiary. Let's bring these people up. Okay, I think I've seen my exchange rates, what I'm talking about. So you'll be given 5 types of exchange rates, or 4, depending on the context of the question. And this is from our slide in the main class on consolidated financial statement masterclass. So when it comes to translating the subsidiary's P&L account, you're going to be using the average exchange rate. So if you check, these are the types of exchange rates that are available when it comes to dealing with foreign subsidiary. Any goodwill at acquisition, we use the exchange rate at the date of acquisition. That is the first one. So we use the exchange rate at the date of acquisition for goodwill at acquisition. We use the exchange rate at transaction date to deal with any intra-group transaction. We use the exchange rate at the reporting date to get a consolidated profit or loss when we are preparing the consolidated profit or loss. Then we use the exchange rate, average exchange rate to deal with consolidated P&L. So the items in P&L of the subsidiary, we will use the average exchange rate specifically to the question that you are having. Then if it happens that probably we acquire the business at the date of, or at the beginning of the year, then we will have exchange rate also at the beginning of the year. So the 0.5, the exchange rate 0.5 and the exchange rate 0.1 may be different. Okay, because we will have exchange rate at the date of acquisition. And if the acquisition is done midway through the year, then we'll also have exchange rate at the beginning of the year. So these are the various exchange rates as per IAS 21, effects of changes in exchange rate when we are translating foreign subsidiaries information into the consolidated statement of whatever we are preparing. Does that make sense, Adongo?
Yes, so in this case, whereby you compare the return earning at the beginning of the year and at the end, and you get your post-acquisition profit. In this case, since we will be treating it at the P&L, we should use the average rate in doing the translation.
Yes, you use the average rates to do the translation.
Okay, sir. Thank you.
All right. Okay. All right. Any other questions? You raise your hand, we bring you up, or you put it in the chat for us, then we can take it up in that case. Yes, Isaac, your hand is up.
Yes, good evening. So when there is foreign exchange loss, how do you?
Foreign exchange loss from what? Foreign exchange loss arising from what?
From this transaction, maybe no, when there is loss, sorry, when there is loss as a result of the exchange rate.
It is borne by the parent and adjusted for, whether gain or loss, it will be adjusted for in the group retained earnings. It will be adjusted for in the group retained earnings because the parent is the one who is going to bear that. I'm asking in what context, because if the subsidiary is sold to the parent and there's an intra-group trading and you're applying the exchange rate at the date of the transaction and you're translating at the reporting date, then the exchange rate movement will be dealt with in the book of the subsidiary to get the movement that will be taken to the consolidated results. But the main translation that you are doing, like say goodwill at the date of acquisition and goodwill at the reporting date, the exchange rate movement in the goodwill will be taken to the group retained earnings. If we are preparing the consolidated profit or loss, then it will be taken to P&L also if we are preparing the consolidated profit or loss. So depending on the financial statement we are preparing and where you put it, that's how you would deal with any foreign exchange movement from the translation as per your question. Then let me see, a question is on YouTube. Let's see if I can look at it. When do we transfer excess depreciation to retain earnings? Now that is under IAS 16, property, plant and equipment. We transfer excess depreciation to retain earnings when there is upward revaluation resulting into additional depreciation and the entity is doing the transfer. So for instance, there is a carrying amount of the asset and it is 10,000. Then there is a revalued amount and it is 15,000. And the remaining economic life of the asset is 5 years. That means that, and the revaluation is done at the beginning of the year. Stay with me carefully. The revaluation is done at the beginning of the year or midway through the year. In that case, as you can see, there is a revaluation surplus here of 5,000. What does that mean? It means that depreciation for the year will be calculated on the revalued amount, because remember, as per IAS 16, depreciation should be calculated on the revalued amount. So it means depreciation for our year will be 15,000 over 5, and that's going to be $3,000. Now, had we not revalued the asset, the depreciation would have been, depreciation on the carrying amount would have been 10,000, would have been 10,000 over 5, and that would have been 2,000. So because you depreciated the asset, you are charging more depreciation excess of 1,000. And shareholders' profit will be reduced, because if depreciation is high, profit reduces. So when that happens, shareholders will lose money. They didn't ask you to upward revalue the assets, so we need to recompensate them. So the compensation will be done if the entity so decides that they want to transfer, then this 1,000 will be transferred from the revaluation surplus. Remember earlier you credited revaluation surplus with 5,000. So now you're going to debit revaluation surplus with a 5,000, with 1,000, which is the excess depreciation. Then you credit your retained earnings, okay, with a 1,000. The credit retained earnings. Now, when we say debit revaluation surplus, it means deduct it. So in your statement of changes in equity, you're going to be deducting that. Then retained earnings, you add it. So when do we do the transfer from revaluation plus to retain earning for excess depreciation? When an entity revalue assets and there is an upward revaluation, and the revaluation occurs at the beginning of the year or midway through the year. If the revaluation occurred at the end of the year and there is a revaluation surplus, you don't do transfer. Why? Because that year you will calculate depreciation on the current amount brought forward or the original cost of the asset. So if the revaluation is done at the end of the year, there is no need to do any transfer for that year because the depreciation has already been done. But if the revaluation is being done at the beginning of the year or somewhere within the year, then there has to be an excess depreciation. Alternatively, your annual transfer calculation can be the revaluation surplus over the remaining economic useful life. So it could be the revaluation surplus of 5,000 divided by the remaining economic useful life of 5. And that is also going to give you 1,000. So you decide how you want to calculate your annual transfer. Either you calculate the depreciation on the current amount or you calculate the depreciation on the revalued amount. The difference between the two becomes the excess depreciation, or you could just pick up the annual transfer directly and then you look at it. So that is the concept about annual transfer when it is done and the condition under which it is done. And that was from Otua Danso on YouTube. Let me know if that makes sense for you. Yes, George, your hand is up on Zoom.
All right, sure. Thank you. So I just need some clarification on when it comes to consolidation for deferred consideration and then contingent consideration.
Right.
So when you are, how do you treat it in terms of determining the fair value of the entity? I mean, if the fair value of the consideration transferred when you are coming to calculate your goodwill, and then in this case, there's a contingent consideration or deferred consideration. How do you go about it to arrive at the fair value of the business?
Okay, so your fair value of consideration transferred may include a component called deferred consideration. Now, like we said, deferred consideration works in accordance with IAS 37, provisions, contingent liabilities, contingent assets. What does that mean? It means at the date of acquisition, we need the present value of the deferred consideration, period. At the date of acquisition, we need the present value of the deferred consideration. Now, you got to read a question pretty well. Sometimes the examiner can be generous and give you the present value. Or sometimes the examiner can say, ignore time value of money. Then whatever figure the examiner gives you, you use it, then you go ahead. But if the examiner gives you the value that is supposed to be paid next year, then you have to discount it to present value, most importantly, using the parent's cost of capital, because it is the parent who is making the payment. So using the parent's cost of capital. So if you are asking, how is that brought in arriving at the fair value of consideration transfer, we always bring the present value of the amount to be paid in the future. Sometimes the examiner will say, ignore time value of money. Then whatever figure is there, you slap it on the face. Other times, the examiner will give you the present value. You read the blueprint well. That way, you pick the figure and you put it down. But other times, the examiner will give you the figure in future, then you discount it into present terms, definitely using the cost of capital of the parent entity and taking into consideration the period up to when that payment is going to be done. So you discount it. So that is how you deal with deferred consideration. Now, remember, immediately there is deferred consideration as per IAS 37. What do you have to do? You have to calculate finance cost. So the finance cost is going to be the present value times the cost of capital so that you get your finance cost. Alternatively, the examiner can give you the present value, then it can give you the value at the end of the year, the value at the reporting date. So the difference between the two will still become finance cost. In that case, if you are preparing consolidated statement of profit or loss, that unwinding of finance cost on the deferred consideration will be included in finance cost on the consolidated statement of financial position. On the consolidated statement of financial position. Sorry, on the consolidated statement of profit or loss. Sorry. But if you are doing consolidated statement of financial position, that finance cost will be deducted from group retained earnings. So the present value is used in arriving at the fair value of consideration transferred. On subsequent measurements, finance cost has to be calculated. Where the examiner says do not take into consideration time value of money, then there will not be any finance cost to be calculated, because it means that same figure will be what will be recognized on the face of the statement of financial position. Remember, if you are doing statement of financial position, then the carrying amount of the deferred consideration will be the present value plus finance cost. And that will be on the face of the statement of financial position, consolidated statement of financial position. Contingent consideration, on the other hand, is where we said we are making payments based on satisfaction of certain KPIs. We are making payments based on satisfaction of certain KPIs. So it means that the subsidiary, the parent said, hey, listen, if you're going to meet certain criteria, I'm going to give you X amount of money. So that also the parent will say it at the beginning of the year, and that figure will be directly given to you, and then you use it. That is it. If at the reporting date, there is a change in that contingent consideration, which will be a reduction, it can't go up. There's only one way, it will come down. So if there is a reduction in the contingent consideration, that is an income, because reduction in liability is an income. So when there's a reduction in the contingent consideration on subsequent measurement, then that will be an income that will be recognized on the consolidated P&L. If you are preparing consolidated P&L, it will come in as an inflow. Then if you are preparing the consolidated statement of financial position, then the reduction in the contingent consideration will be added to the group retained earnings. Then the revised amount that has to be put in there will be taken to the statement of financial position as the amount relating to contingent consideration. So that is how deferred consideration is dealt with and contingent consideration is dealt with. Only one of them will be in a specific scenario, not the two, because they are all future payments. One is based on meeting a criteria, which is the contingent consideration. The other is payment without meeting any criteria. So in a given consolidated financial statement question, that is only one of these guys will be there, but that is how you deal with them in arriving at your fair value of consideration transferred to calculate your goodwill.
All right, thank you very much.
Right. I'm seeing some charts coming in here. Please, sir, can you take the treatment of exchange gain or loss again? Exchange gain or loss from what? If you're dealing with exchange gain or loss as per IAS 21, exchange gain or losses are recognized in the profit or loss account. Any exchange gain or loss will be recognized in the profit or loss account for the entity. If you are referring to the question that was asked earlier, that is a consolidated exchange treatment, and that is not in your syllabus as an FR student. So as an FR student, if you calculate the initial value, you translate, reporting date, you translate, the movement in the exchange rate, gain or loss, it will be recognized in the P&L account. Will be recognized in the P&L account. But remember, exchange gain or loss will come in on only monetary items or items whose fair value will be measured in the foreign currency. So, for instance, if we bought goods on credit, then subsequent measurements, the goods will be carried at IAS 2, definitely. So you don't retranslate at the reporting date. But the trade payable figure is a monetary item, and that will be translated at the reporting date. So the trade receipt payable will be translated at the reporting date. So the difference between the transaction date value and the reporting date value is what will go to the P&L account. And because trade receivable, trade payable, they are monetary items. The inventory, if it is still at the reporting date, no translation, because on subsequent measurement, IAS2 is going to apply. But then there are certain assets, their fair value will be determined in foreign currency. So assets whose fair value can be measured in foreign currency. If we have the asset like that in the question, and the fair value can only be measured in the foreign currency, then even though the asset is a non-monetary item, it will still be translated at the reporting date using the reporting date exchange rate. Then in that case, the difference between the exchange rates will be recognized in the P&L account. So primarily, any foreign exchange gain or loss is treated in the P&L account. You just have to know how to deal with monetary items and non-monetary item, and what to translate at the reporting date and what not to translate at the reporting date. So that is the issue about treatment of gain, exchange gain or loss. Please, it looks to me like you are not recording today's. Yep. It's not something that will be made available. So, we can get access to it on our cloud. So no problem on that. Yes, Timothy, your hand is up. What you got?
Say. Hello, say.
Yeah.
Please, so net asset turnover, is it over total asset or over net asset by taking the current liability from it?
You said what?
Net asset turnover.
Mm-hmm.
Is it over total asset or it is over net asset? Like by taking the current liability from the total asset to get the net asset.
It's over capital employed. Net asset calculation is revenue divided by capital employed. And there are two ways capital employed can be calculated. Either you are using total asset minus current liability, or shareholders fund plus long-term debt. So you have to listen to the question if there are exceptional statements the examiner makes and asks you to treat some things as debt in calculating ROSI and asset turnover, then that means your total asset less current liability issue will not work there. So it depends on the context of the question, but by default, it is revenue divided by capital employed, which can be total asset minus current liabilities or shareholders fund plus non-current, shareholders fund plus long-term debt. Shareholders fund plus long-term debt.
The reason I'm asking that the last year's they used total assets. So I was comparing like, is it me that is made a mistake or is them? That's what I'm asking.
So it depends. Sometimes if the examiner says total asset turnover, if the language is
it was saying net asset
and the total asset was used.
Yes,
I don't know, but just stay with what you're supposed to do.
Okay.
Capital employed, that is total asset minus current liability, or do shareholders fund plus long-term debt. So just stay with what you know to be true.
And the last one for now, deferred tax liability. Is it also part of the non-current liability in terms of ratio?
Deferred tax liability, is it part of what?
Is it part of long-term liabilities, like in terms of ratios?
No. It is not debt. When we are doing gearing, we calculate gearing on interest-bearing debts. On interest-bearing debt. Deferred tax is not an interest-bearing debt, so it is not considered when we are dealing with gearing. Our focus is on interest-bearing debts, and that is why we would deal with just loans, and then sometimes the examiner would ask us to use leases also as, how do we call it? Long-term debt. So usually it's going to be on interest-bearing debt.
Okay.
All right. Okay, so that's it about that. Any questions, you raise your hand, we bring you up, or you put it in the chat. For me, real quick, I'm seeing some questions coming in the chat. I want to bring up a slide on that quickly, then I take it, because there's just a slide here I could share with you. Those of you who have my book, you will see that in the book. Please, the difference between compliance and integrity-based, I think you're talking about ethics management. So for those of you with my book, you'll find this on page 42. I think I've referred you to this before. Whether you have the corporate reporting book or the financial reporting book, you'll see this there. So there are, when it comes to management of ethical issues, now this is a question the examiner can throw at you. According to Line Payne, he said that organizations can manage ethics using two approaches, and that is compliance-based and integrity-based. Now, what is the difference between the two? The compliance-based is primarily designed to ensure the company acts within the letter of the law, and that violations are prevented, detected, and punished, period. That is compliance-based. So it is a checkbox approach. Okay, the law said we should do this, we've done it. The law said we should not dispose things by heart. We have not disposed things by heart. The law says we should pay tax. We've paid our tax. The law says we should do this. That is compliance-based. So it's like, you know, just checking the box, and we go with the letter of the law. What exactly did the law say? We act and carry out our business based on what the law has said. For that reason, the entity put in place a couple of measures to prevent, you know, legal actions against the company. Like, there are compliance procedures that are put down. So every time on a regular basis, the entity's internal auditors and the entity internal inspection officers are making sure that, hey, what Food and Drug Authority said, are we adhering? Ghana Standard Authority, are we adhering? Tax, are we adhering? BOG, are we adhering? Like, whoever, what kind of industry that we are in, their laws, are we adhering? Then they make sure that they audit all contracts. There is also a whistleblower opportunities, meaning the organization is structured in such a way that when you see something smelling, you can come and say it, you'll be shielded, nobody will punish you. Then there are disciplinary measures put in place so that in case somebody make the entity to become liable for something, we sue, the person is punished. That is the compliance base. So the entity carries out its activity, its operation in the to the letter of the law, or within the letter of the law, period. But you see, really, if you want to run a successful organization, you cannot just go by checking the box. That is too robotic approach. So a better way to run organization very well, and also to ensure that the organization achieve its objective, is what we call the integrity-based approach. This is where the entity goes beyond the letter of the law to the spirit of the law. So yeah, there is something that the law has said, but really, what is the implication of it? What really is it about? So the entities strive to go beyond, what the law has categorically stated, and to really become the best in what it does in that regard. So what does that mean? It means that we combine a concern for the law with emphasis on managerial responsibility for ethical behavior. So yeah, the law says every company should pay their tax. That's good. That's good. We pay our taxes. But then you don't pay your taxes and not, dispose of waste very well. You don't pay and say, after all, we have paid our tax. Government is responsible to make sure that the waste is dealt with. No, we pay our taxes, take care of our waste. Or we pay our taxes and carry out social responsibility. We don't say, we've paid our taxes, so government has to build schools, government has to do this. We didn't ask the government to be traveling around with private jets around the world and chilling in the air. We didn't ask the government to do that. No, integrity-based means we run the organization in such a manner that we go beyond what is within the letter of the law and be reasonable people. As a company, we've paid our tax. But then, can we do some corporate social responsibility? Can we give people scholarship? Can we provide water to the communities that we are operating in? Can we, construct the road leading to our office or leading to the community that we are operating in? That is the idea about integrity-based. So if you ask the difference between compliance-based and integrity-based, that is what we are talking about. So compliance-based, we operate our businesses within the letter of the law. But integrity-based, we are going for the spirit of the law, meaning we are concerned about the law, but also concerned about ethics. So that is the idea about that. And then for those of you with the book, you will see the descriptions or the differences between that. I'm not going to go into that. But those of you with the book, you will see the distinctions between the compliance-based and the integrity-based approach there in the book that you can look out for and see there for that. So that is the idea about compliance-based and integrity-based. Yes, James, your hand is up.
Sir, thank you. The question, maybe for now, I'll ask about 4 questions. The first one is, in business valuation, assets method, how do you treat leasing if there's a lease in the question? And then also, in business valuation, the dividend method, how do you treat the constant dividend method? If you can throw more light on that one for me. And then the third one, I want to get the different.
No, relax. Lease is a liability, quote unquote. So it depends on the judgment that has to be paid. Because when you recognize leases as per IFRS 16 leases, it's a liability. We treat it as a liability. So if we are valuing a business, there are 2 schools of thoughts. Either it will be written off, because the fact that we have leased does not mean we are under obligation to pay that money. So there are 2 schools of thoughts. Either it will be treated as not a liability because the entity is not under obligation to pay that money. The entity doesn't owe the lessor that money. So that is the first school of thought, that because the entity doesn't owe that money, then it will not be included in the determination of the net asset of the entity whose value is being determined. Then there is another school of thought that says that the lease has been signed anyway. If you come and acquire the business, you have to continue with the lease. So for that reason, it should be included. So these are the 2 schools of thought for dealing with lease liability, and you state the assumption that you are using to do your calculation, and you'll be marked when it comes to dealing with that. So the lease liability.
So following that, in terms of ratio calculation, is it the same assumption when you are dealing with asset turnover?
We have established that if there is lease obligation in the question, until the examiner says it, lease obligation is not an interest-bearing debt. So it will not be part of dealing with long-term debt. But if the examiner makes the statement that lease obligation should be included or should be treated as debt in calculating ROSI and asset turnover, then you will include it. But if the examiner does not make that statement, it is not an interest-bearing debt, so it will not be included in calculating capital employed. I hope you get that distinction. So it depends on the context of the question. If the question is quiet, it's not an interest-bearing debt, it will not be included in calculating capital employed. But anytime, what we've seen is that all questions that have leases in ratio calculation, the examiner will tell you that the lease should be used as an interest-bearing debt in calculating the ROSI and asset turnover. So unless the examiner makes that statement, leases are not interest-bearing debts.
Okay.
Leases are not interest-bearing debt. Then there's second issue about dividend valuation method. We established that the value of the business will be DO over KE, that is the cost of capital of the business, if we are valuing the business using the dividend valuation module. So this is dividend per share, and you would have to calculate that for the company. And then the cost of capital will also be provided to you as well for you to deal with. Either you can use total dividend of the entity divided by the cost of capital of the entity. You can also use average dividend if they have maybe dividend over a period of years, still over cost of capital, to determine the value to be placed on the business. So with constant dividend, that is how you calculate the dividend, the value of the company using the dividend valuation model as well. So that is it about that.
So I'm talking about where dividend, multiple of dividend that has been paid for a year.
When you say multiple dividend paid for a year, I don't understand.
I'm not saying I don't know how to put it, but when dividend pay is you are dealing with dividend model, and dividend pay is not just for one, but a series of dividend for a period.
That is what I'm saying, that you can use average dividend payment. That's what I just said here. So if we have 5 years, dividend paid for 5 years, you can use average dividend. You add all the 5 years divided by 5, that gives you average dividend. And so you can use the average dividend to then place a value on the company. You can use the average dividend, or use the current year dividend to calculate the value of the company. It's optional on what is happening.
Oh, and again, how about the constant dividend method?
This is constant dividend. This is constant dividend.
Growth, constant.
If there is growth in dividend, PO is DO 1 plus G over KE minus G. This is the formula. So if there's a growth in dividend, you have to calculate the growth in dividend. And we have the past dividend method, and we have the Gordon approximation method, because you have to calculate the G, which will be built into the formula. Then you can calculate the value of the company. And we have the past dividend method, which is the nth root, the final, over initial minus 1. This is in percentages. Remember, the square root sign or the root sign doesn't cover the 1. So if the examiner gives you dividend for, say, 5 years, your N will be 4. I've told you that the N is always the number of years given minus 1. So the N will be 4. You do your calculation. But there is also Gordon approximation, where G is equal to, what is it? Is it B times R or so, something like that, where the B is required, the R is required rate of return or the cost of capital of the company. And then the B is the profit retained, percentage of profit retained. So these are the two ways that the growth can be calculated in dealing with the growth in dividend. So it depends on what is given to you. If the examiner gives you historical dividend payments, then certainly you calculate the growth using the past dividend formula, nth root, final over initial minus 1. But then if you are given the question in another format, then you have to calculate the percentage of profits retained, multiply that by the cost of capital, that gives you the growth rate. Then you come back and substitute that into the formula, and the DO will be your current year dividend. DO becomes your current year dividend, and that will help you to place a value on the company. KE is still your cost of capital, and that will also be given to you in the question or in the example. So that is the idea about how you deal with the growth in dividend. So constant dividend, DO over KE, growth in dividend, DO 1 plus G over KE. Remember, all these formulas will not be provided to you in the exam hall. So it is important you know this as well. So that is the issue about dividend valuation module as well for that.
Last but one, the difference between spin-off and carve-out and divestiture.
Divestiture is we selling off our investment. That is divestiture. That is what Vodafone parent company wants to do with their investment in Ghana. They are seeking to sell their 70% ownership in Vodafone Ghana because they are seeking to reorganize their company or the group of company as a whole. So they are seeking to sell the 70% share. It was supposed to be completed last year with another acquirer, but it didn't finish. So that is divestiture. So we're just selling, the business and we go away in that case. Carve out is where we have a part of a business, but then we are now removing that business to establish it as an independent organization on its own in that case. So that is going to be the issue about carve out. So we have a companies coming in. So NP group, just NP. Let's say we have 3 divisions. We do condoms, we do sanitary pads, and we do whatever the heck can we do? Let's say we do maybe underwears. Then for some reason, the sanitary pad division is doing so good. So we want to establish it as a new company, independent on its own, so that it is not treated as a division. Then that is going to be an idea about carve-outs that we need to know about. Now, spin-off, what was the word you used? Spin-off is the same idea, only that the shares of the company in relation to carve-outs, a portion of the share can be owned by outsiders. We can decide to list the company on the stock exchange so that a portion of the ownership will be owned by outsiders. But then in spin-off, usually the ownership will be to the existing shareholders of the company. The ownership will be to the existing shareholders. All are just about establishing new firms, either from an existing portion of our operation or just a new business as a whole. With carve-out, the ownership can be relating to some outsiders coming in to come and buy some of the shares, or spin-out, the ownership can be just to the existing shareholders. But all has to do with we establishing new businesses from an existing business or to a new business, all other things. So that is also the issue about that.
Yeah, last but one, the principal government operating segment.
What is specifically about operating? Now, operating segment, we mentioned that the first thing is to identify what the heck the operating segment is, and we establish a couple of rules relating to operating segments. Let me see if I can bring that slide up quickly, and then I'll take questions from another person. In that case, let me see if I can just get my slide on that. IFRS 8, that's in the accounting standards segment reporting. So 385. Yeah. Okay. So this is the rule we established. We said that an operating segment is simply a component of a business or an entity that engages in a business activity that earns revenue and also incurs expenses. And number 2, whose activities are regularly reviewed by a chief operating officer. But how the heck do we identify an operating segment? Very simple. We said that to establish that, okay, an entity is an operating segment, number 1, it has to meet the definition of what the heck an operating segment is, which is what we establish above here, that it's a component of our business. So just like what I had here, condom division, sanitary pad division, underwear division. So if the condom division, they earn rev and they also incur costs, yeah, that is what we mean. That's the first thing. Number 2, that, the activities are reviewed by a chief operating officer. Remember, the chief operating officer can be an individual or group of individuals coming in. And then number 3, we have discrete financial information about it. So yes, do they incur costs? Do they have revenue? Are their activities being reviewed by somebody? Do they have separate financial information? If that is the case, criteria number 1. But the segment total is 10% or more of the revenue of the entire group, or all segments not reporting a loss, all segments loss is greater 10%, or their asset is 10% more. What the heck does that mean? It means that our condom division, yes, they earn revenue, incur cost, but in addition to that, what is the total asset? What is their portion? What is the percentage of their asset of the total asset of NP? If it is 10% or more, they meet the criteria. How about their total revenue? If their total, so if their asset doesn't meet the 10% threshold, how about their revenue? It could meet the 10% threshold, or their profits could meet the 10% threshold. So that is the criteria for recognizing that. So number one, it must meet the definition of what the heck an operating segment is. Then number two, the 10% rule. Either their total asset is 10% or more of the asset of the head office or the entire company, or their revenue is 10% or more of the asset of the entire company, or their profit is 10% or more of the entire profit of the entity. That is how we recognize an operating segment when it comes to IAS 8, and that is the issue about that. Let me take other questions from other people as well, so that I don't become too monologue, because we have other questions from others as well. So you can come on later with your, I think you said you had another question coming up. Please, can you go over when inventories are for repurchase option? Okay. When inventories are for repurchase option and the entity include the amount in revenue and receivables. Yeah, if the inventory is repurchase option, that means it's not a sale, so we have to remove it from sales, remove it from cost of sales and all that, because sales with a repurchase option, is actually a financial arrangement as per IFRS 9, so must be treated as financial liability. So what do? The revenue or the sales figure from this sale with repurchase option will be included in revenue. So you remove it from the revenue. Then the cost of the inventory will be included in cost of sales. So remove it as well from cost of sales. Then the sales value will be included in receivables per your context of the question. It means we sold on credit. So you subtract it from receivables as well. So the sales figure will be deducted from sales. Since it's just on credits based on your scenario, based on your question, we subtract the same thing from trade receivables. Then the cost of the inventory will be subtracted from cost of sales. Now, after we do that derecognition, we now have to recognize financial liability. Then we will calculate interest on it, and that interest will be accrued in the P&L accounts and also added back to the value there, and also added back to the value. So that is how you deal with the sales with repurchase option. Remove the sales from the revenue figure, remove the cost of the inventory from the cost of sales, go and include it in closing inventory because you have not sold it yet. So deduct from inventory, deduct from revenue. That's what we're saying, number one. Number two, deduct from receivables, trade receivables, definitely the same sales value. You are deducting from these things. Three, the cost of the inventory deducted from cost of sales. But then you're going to add it to closing inventory because it should be included in closing inventory. And that is the cost of the inventory that we just sold. So the cost of the inventory will be deducted from cost of sales. Then you go and add it to closing stock because we have not sold it. The inventory is being used as collateral facility. So we have not sold it yet. So it has to be included in the closing inventory of the company. And they have not included it. So you go and add it back on the face of the statement of financial position. Then you now recognize financial liability. And then you calculate finance costs on that and recognize it in the P&L. and take it to the statement of financial position as well. So you recognize financial liability being the sales value, okay? Because that's the money we got, being the sales value. Then you calculate finance cost on that. And the double entry for the finance cost is debit P&L because it's an expenses, and credit the financial liability. And credit financial liability. So that on the face of the statement of financial position, you will have financial liability being the sales revenue plus the finance cost you calculated. So that is the full treatment for sales with repurchase option. That is a full treatment with sales and repurchase option. Sales and repurchase option. So that is the issue about that. Then hi, sir, how to deal with deficit on revaluation of PPEs. That is Aziz Chilumba on YouTube. How to deal with deficit on revaluation of PPE. I think you are looking at revaluation loss. Yeah, by default, you know, by default, revaluation loss must be taken to P&L. Okay, so you just recognize it in the P&L because it's an expenses. Recognize it in profit or loss. That's the default treatment for revaluation loss. However, there's an alternative treatment as per IAS 16. The alternative treatment is that if the asset that is having revaluation loss now has a previous revaluation gain, then the revaluation loss must be written off against the gain, and it is the excess that will go to the P&L account. What does that mean? It means that we're going to rather debit revaluation surplus, that is also debit OCI with a revaluation loss. Then we can credit property, plants, and equipment there. Now, if it happens that the loss exceeds the gain, then the excess is what is taken to the P&L account. The excess is what is taken to the profit or loss account. The excess, that is the balancing figure, is what is taken into the P&L account. So default treatment, if we hear, oh, we have revalue assets, the value of the asset has fallen, no P, all we do is, you know, recognizing the P&L account and credit your, so here you are debiting profit or loss, and then you credit property, plant, and equipment. Very simple. That's the general entry, and you go away. But if the asset that is suffering the loss has a gain previously or gain outstanding, then certainly it will be recognized in the OCI or recognized in the revaluation loss first. And the excess is what is taken to the P&L, which means if the loss is not more than the gain, then there will be nothing that will be recognized in the P&L account relating to the revaluation loss. So that is the answer to the question, Aziz Chilumba on YouTube. That's how you deal with deficit arising from revaluation of assets. Deficit arising from revaluation of assets. So is it possible to do these examples with real numbers? What we're saying here is if you revalue the assets and you have a loss of 10,000, you just debit revaluation surplus, you debit your profit or loss with a 10,000 and credit PPE, subtract it from PPE 10,000. But the alternative method is previously you had a revaluation loss, a revaluation gain on the asset. Let's say you have a gain of 10,000 on the asset. Then on subsequent revaluation, you value the asset and the revaluation loss that came up is say 3,000. We are saying that because the asset previously had a gain of or surplus of 10,000, this loss will not directly be taken to the P&L account. So what do? You debit the revaluation surplus and you have to debit OCI as well with that 3,000. And then you credit property, plant, and equipment with a 3,000. And as you can see in the context of this question, the revaluation loss is less than the surplus we are having. So now when we go to statement of financial position, the carrying amount of the revaluation surplus will be the 10,000 recognized earlier minus the loss of 3,000, so that the carrying amount becomes 7,000. But then if the opposite is true, the loss is 10,000 and the gain previously recognized is 3,000, that is where we said that, yes, you will still debit revaluation loss with the 3,000 that is available in it and debit OCI. We will credit PPE with the loss 10,000 that we had. Now, because the loss is more than how much is available in the revaluation surplus account, you have to take the balancing figure to profit or loss, which is going to be 7,000. That's what we are trying to say, that if the loss is more than the revaluation surplus, the balancing figure goes to the statement of financial, the profit or loss for the period under review. So that is the issue about deficit when there is revaluation on PPEs. When there is revaluation on PPEs. Let's see, what else do I have? Okay. Yes, Isaac, your hand is up.
Say, with respect to operated the entity should have more than 10% of its profit or loss. So I'm asking, maybe if the figures are in table and the profit or loss column, you have to adjust it with the positive one, then come and find 10% of the negative one.
I didn't hear anything you said. Make sure your network is good or your device is okay. If you can start again, because I didn't hear anything.
Hello.
Yeah.
Hello.
Yes.
Hello.
Yes. Hello.
Yeah. I'm yeah. In relation to operating segment. Okay.
Yes.
You said the segment should have 10% or more of its profit or loss. So my question is, if
I think your network is not helping. You can
maybe the figures are given, maybe you have the profit or loss there, then you have maybe positive figure there, which is in a way the negative.
I think your network, we cannot follow you up. So maybe you can put it in the chat for us. And then we can get it up for you, because your line is just breaking up and I cannot follow what you're saying. So if you can put it in the chat for me, that would be good there. We cannot hear you. So if you can put your message on the chat, because your line keeps dropping, I think your network keeps dropping you. So if you can put it in the chat, we can read it and then take it up there in that case. Any other questions, you put it in the chat or raise your hand and we can bring you up. Okay, so I'm seeing another question here. Good evening, sir. This is Mr. Samuel Sapon. Please, share of profit for subsidiary in the consolidated income statement. Do we always deduct impairment loss in addition to the depreciation and PUP for subsidiary? I don't understand the context of your question, Samuel Sapon, but when you're doing consolidated income statement, share of profit from the associate doesn't come on the face of the consolidated income statement. So I don't know what they are trying to drive at. It is associates, share of profit from associate that comes on the face of the consolidated income statement. But share of profit from the subsidiary does not come in the consolidated income statement of the entity. So I don't get a context of your question. So probably if you can restate or something like that, and let me get a context of your question, because what you're saying does not exist or is not done. So maybe give me some context in relation to what you're actually talking about, then I can provide you with a better answer on that one. Then another question coming up is, do you provide training for COA exams? If yes, nope, we don't do that. Love your country. More grease to your elbow, Prof. Okay, oh, that is Math Academy. Then another question is coming up. Let me take this. It says that, sir, please put light on use of weighted average cost of capital, explain its formula, and how does it provide benefits to take decision. Okay, so I think that is financial management related. But we are looking at FR and CR here. But let me just talk about that briefly, then I go away. Now, weighted average cost of capital is where we are financing our activities from both debt and also equity, from both debt and also equity. So when the entity is providing or financing its operations from debt, then we have to calculate KD of that. If it is providing its finance from equity, then we have to provide also KE, or the capital asset pricing module, or the capital asset pricing module. So the weighted average cost of capital comes in when an entity is using hybrid finance. That is, they are using both debt finance and equity finance to look at the operation. In that case, that means to calculate the cost of capital, which we will use to appraise the project, or to calculate the cost of capital for the company, we would have to use the weighted average cost of capital. And formula-wise, let me see if I can just bring that up from my slide here. Formula-wise, weighted average cost of capital, that's what you see here. Let me bring this up. This formula will be given to you in the exam hall. You just have to know what the heck you're supposed to do there, or how you're supposed to use the figures there. So there you go. So that is the formula. VE is value of equity. To get value of equity, it is going to be the number of shares multiplied by the share price. Value of debt is also there. You bring nominal value of the debt, multiply by the number of bonds that we have issued. T is tax, and you can build that into the system. So that is the idea about weighted average cost of capital. So the context of your question is, how does it provide benefit to take decision? The benefit is, if the entity is using both debt and equity to finance its activities or to finance a project, then it is prudent to calculate the weighted average cost of capital, taking into consideration both the debt elements and the equity elements. But if we are using just equity to provide a finance, then we'll use the KE, cost of equity, or capital asset pricing module. If you are using only debt, then we are going to use KD after tax, or KD before tax for the company. So that is it for you. I think that was from Love Your Country. That is about the weighted average cost of capital and how it is dealt with. Say diluted earnings per share. Please, some overview. I don't get a context of your question. There are a couple of things that will come on diluted earnings per share. Two things that you have to generally know about. Diluted earnings per share could come as a result of share options. If an entity offers share option, or an entity offer or an entity issue convertible loan notes. Convertible loan notes. So let's take the ideas one after the other. When the entity issues convertible shares or convertible loan notes, let me put it that way. When an entity issues convertible loan notes and we are calculating earnings per share, this is what we do. This is what we do. We're going to pretend that they are converting the shares at the reporting date. That is the idea. So the assumption is that the bondholders have converted. That is the assumption we use. So the bondholders have converted their loan notes. That's the idea. If that is the assumption we used, that the bondholders have converted their shares, what does that mean? You know that it means we will no longer pay the interest to them because they are convertible debts. We have to pay interest. Now, you know, interest is also tax deductible. So if you're not paying the interest to them, then you're also going to lose the tax benefit on that. What does that mean? It means we have to adjust our profit. So we're going to be bringing in the profit for the year, which will be given to you in the question of the entity. So we bring in the profit for the year, which will be given to us in the question like that. Then we will bring in the interest, which we will no longer pay. Add interest. So how much interest will we have paid on the convertible loan notes? And that is going to be the nominal value times the coupon rate. All these will be given to you. You know the nominal value, you know coupon rate already. It's not here. We are going to teach you that. So you no longer pay that interest. So you add it. But like I said, interest is tax deductible. So if you're not paying the interest, then you will not also get the tax benefit on that. So we're going to less the tax benefit. And the tax benefit is going to be the tax rate, which will be given to you in the question, multiplied by the interest. Sounds good? Then you subtract that. So this gives you interest net of tax. This gives you interest net of tax. So you add that, and that gives you the adjusted profit. That gives you the adjusted profit. So when an entity issues convertible loan notes, there is going to be dilution in earnings per share. So the first thing we do is that we need to adjust the profit. And the assumption is that at the reporting date, the bondholders have converted their loan note into shares. If they have converted, we no longer pay the interest. So it's, if you're no longer paying the interest, it was deducted in arriving at the profit for the year. So you add it back. Now, if you know you are no longer paying the interest, then the tax benefit, you also don't get it. So you subtract it so that you get an interest net of tax. So your adjusted profit figure is actually going to go up, will be higher than the profit for the year. That's the thing. Then you need to calculate WANEs. That's weighted average number of equity shares. How the heck are you going to do that? Very simple. Just bring in the equity shares for the year. Equity shares outstanding for the year. Then you bring in the issue relating to, how do we call it? The number of shares converted. Number of shares converted as well. Now, the examiner will give you the conversion policy. So for instance, say, oh, every whatever the heck 1,000 bond is converted into 500 shares. Okay, if 1,000 bond converted into 500 shares, then, and we have the nominal value of the loan notes to be, 20,000, then how many shares are we going to get? So if 1,000 is equal to 500, then 20,000 will be equal to how many shares? You cross multiply, divide, and then you go away. So it becomes 20,000 divided by 1,000. So the number of shares from the conversion will be 20,000. I want to write Ghana city and I'm messing it up with the dollars. Divided by 1,000 by what? 500. So the examiner will give you the conversion policy of the entity. So whatever conversion policy the examiner gives you, you put it in and then you get your answer for the period under review. And that is how you calculate the weighted average number of equity shares when there is convertible loan notes. Once you have this, you can now calculate your diluted earnings per share. And that is going to be the adjusted profit divided by the weighted average number of equity shares. But remember, anytime the examiner says calculate earnings per share, you first have to calculate the basic earnings per share, which is going to be, your profit for the year, or PATES, you know that already. That is profit attributable to equity shareholders divided by the outstanding shares. Divided by the outstanding shares. So the basic earnings per share will be calculated. Then you now come and do your workings to adjust the profit, and then you get your wins as well. That is the first component of diluted earnings per share. That is the first component of diluted earnings per share. The second component is where an entity issues a share option. So when an entity issues a share option, the idea is that the share option is a benefit or an incentive given to employees of the organization to become, part owners of the shares of the company. Note that share option have no implication for the purpose of IAS 33 earnings per share. It has no implication on the profit for the year. It has no implication or effect, if you want to, on the profit for the year. So we don't adjust profit. That's what we are saying here. All right. So no adjustment of profit. Unlike convertible loan notes where you adjust the profit, like we did here, in share option, you don't adjust the profit because it has no implication on the profit. It has no implication on profit. So no adjustment of profit. But then we need to calculate our wins, weighted average number of equity shares. How the heck do you do that? Now, the way you calculate the weighted average number of equity shares is, number one, you calculate what we call the percentage of dilution. The percentage of dilution. You see, what happens in share option is that we let employees of the company buy shares at a price below the share price of the company, below the current share price of the company. So the examiner will give you all these information, but then our percentage of dilution will be calculated as the share price that will be given to you in the question. Don't worry. Then the exercise price, that is how much the employees will pay to buy the shares, divided by the share price, again, times 100. And so your percentage of dilution, you calculate that. The share price is the current share price. The examiner will give you that. You don't have to calculate it. The exercise price, he will tell you that. And it is always lower than the trading price of the company, because if not, what is the incentive the employees are getting? They will pay less than the value of the company. So the difference is becoming their gain. That is why it is called an incentive given to employees. Then once we calculate the percentage of dilution, number two, we then now calculate the number of shares in the option. Number of shares in the option, in the share option. So how do we do that? Number of shares in the option, very simple. So number of shares will be the percentage of dilution you did in the step one. You did in step one, multiply by the share option. And that will give you, that will be given to you in the exam, or the number of shares in the share option. The share option will be given to you. And so that gives you the number of shares in the option. Once you get that, you can now calculate your wins, so that your weighted average number of equity shares will be the outstanding shares for the year plus the number of shares in the option from step two. So once you get your wins, this is how you calculate the weighted average number of equity shares when you are dealing with share option. Once you get that, then your diluted earnings per share will be able to flow as the profit for the year, or PATES. Remember, it's not adjusted, just the same figure you pick, divided by, the weighted average number of equity shares that you just calculated. The weighted average number of equity shares that you just calculated. So these are the two issues that may lead to having the idea about the dilution in earnings per share. Okay, so either it is a convertible loan note, in which case, note how we adjust the profit and look at the assumption we use, sorry. Then look at the way the weighted average number of equity shares is calculated. Then number two, if there is a share option, it doesn't affect the profit, so you don't adjust the profit. So what you have to be thinking about is how the heck can I calculate the weighted average number of equity shares? And that is how you deal with that. Then we look at the next one. It says, what, please, what are the preferable words to use in ratio analysis, greater than or less than? We have mentioned this already relating to what you're supposed to use. It's not about greater than or less than. The only thing is, if you're comparing the entity with industry average or another entity, then you have to make sure that you are not using words like reducing or increasing or rising or falling. It's not mango that is rising, or it's not a sun that is rising or mango that is falling. So if you are comparing the entity with industry average or another entity, you cannot use increasing or decreasing. You cannot use rising or falling, because nothing is rising and nothing is falling. Nothing is rising and nothing is falling. Apart from that, whatever other analysis that we are making, whatever choice of words you want, if it is the same entity year on year, yeah, it's greater than, less than, reducing or increasing, falling or rising, and all that can be used. So if you cannot use reducing or increasing, rising or falling when you're comparing an entity, an industry average, or another entity, so that is where you have to use greater than or less than, higher or lower. Yeah, those are the things that you can use if you're comparing an entity with an industry average. Apart from that exclusivity, the other statements are applicable for the entity. How do you discount an intangible asset like patent into its present value under the asset method? The question will tell you how you are supposed to discount it. The discount factor will be provided to you. And they, like we solve a question like that. If the patent will earn income of 40,000 in perpetuity, your present value will become 40,000 times 1 over R. The R is the cost of capital of the company, and that will be given to you in the question. So the way the value that will be earned from the entity will be provided from the patent will be given to you, and you discount that into present terms using the cost of capital. Because it will be in perpetuity, we use 1 over R. That is 1 divided by the cost of capital of the company. And that will be given to you as well in the question for you to know how to determine or how to get the actual present value. And the operating segment, do you have to find 10% of the profit and the profit or loss, or you offset the loss against the profit before you find the and the presentation of the ratio analysis? I don't get a context of that. What we are saying about the 10% is like the scenario we put up, NP. We have a condom division, we have a sanitary pad division, we have the underwear division. So these are the 3 divisions we have. And we want to test if we can prepare separate financial statements or if any of them meet operating segments. If we are dealing with their assets, we have a total coming up here. We illustrated this in class very well. The total will go here for the entity. So if total, we are having assets of 100,000, and this guy, underwear division has an asset base of say 25,000. Sanitary pad division has an asset base of say maybe 80,000. No, that's too much. Maybe 70,000. Then the condom division has an asset base of 5,000. You do 10% of it for the period under review of the total that we are looking out for in that case. So if you do the math, you realize that percentage-wise, this guy is taking 5%, this guy is taking 70%, this guy is taking 25%. So the condom division on asset basis cannot be dealt with as an operating segment because its asset base is, less than the amounts that is available. It's less than the 10% threshold for identifying. So if we are using asset as the criteria for determining what an operating segment is, then certainly the condom division will not be used or will not be an operating segment, but the sanitary part division and the underwear division, they have exceeded the threshold for net assets. If you are using profit or loss, let's say the condom division made a loss of say 20,000. The how do we call it? The sanitary part division makes profit of 40,000, whatever we have, and then the underwear division makes a profit of whatever the heck, let's say 15,000. So on a group level, for the total, that is going to be an amount of 35,000 in that case. So the net profit is going to be an amount of 35,000 on the group level. So they made a loss. Whatever be the case, we will deal with the absolute. So percentage of the total, you realize that it is going to be 20,000 divided by 35,000. So 20 over 35 by 100, that's going to be like 57% of the profit. And 40, this guy did 40 over 25, sorry, 35. They're going to exceed 100% definitely. That's 114. And this guy's did 15 over 35 times 100. That's going to be 43%. So in the concept of profit or loss, making the decision, then they will all be dealt with as an operating segment. So imagine if this is the test, these are the two options we have available to determine what an operating segment is. It is either or, not that they have to meet the two criteria. So asset basis, condom division doesn't meet the criteria. But if we come to profit basis, condom division meets the criteria. So we have to still treat it as an operating segment. So that is the idea about how we determined the operating segment for the period under review. So it is always on the total, what you did of the total, or what you have of the total to determine whether we can classify you as operating segment or not an operating segment. Now, remember, before these things come, it has to meet the core definition that we established earlier for that. So that is the issue about the operating segment as well. Then what else do I have for this? James, you can come up for your last question, for the other question you were having. As I pick a question here, Love Your Country said, what professional qualification you are offering classes or training for? We offer classes for ICAG, that is Institute of Chartered Accountant Professional Qualification Program. And then we have a regular class for that is running. And then ACCA is on a private basis. So we also offer tuition for ACCA, but that is on private basis. But that starts at 3,200 Ghana cedi per paper for 12 sessions. So that is 3,200 Ghana cedi per paper for a private session with me for ACCA. And that gives you 12 sessions for that price. And that is a starting price. It means it can be negotiated upward, but cannot come down. So it can be negotiated upward. So these are the two things that we technically offer tuition on. Love Your Country. Then Dem said, God bless, lovely. Okay. Sports Tube said, hi, say hello. Okay. Right. So any other questions for me? James, if you're available, you can come up with the other question you said you had.
It's raining over here. It's raining over here. I can't get it.
Oh, okay. I hear. And then Nyame Adoma Ibisha. So that is the issue there. Let's see. Do I have any other? You-
130.
130. Madakra Minty. Okay, so let's see. What else do I have? Ajua Danso said, is it Ajua? I don't know. Hello, sir. When convertible loan notes are dilutive, how do you calculate earnings per share? Okay, I think I've already dealt with that. When there is convertible loan note, that is what I discussed here with Timothy's question on issue about diluted earnings per share. So I think I spoke about that, Danso. Let me know if that makes sense for you as well. Okay, so I think on YouTube I've addressed the questions here as well. Okay, let's see, do I have anything in the chat here? Okay, thanks. Okay, that's fine. Yes, Isaac, your hand is up.
Hello, sir.
Yes.
Yeah, my question was, you see, for the operating segment, you see, please, I would like to see what you did, the illustration you brought. You see, under profit or loss, quantum division was having a negative figure, which is 20,000. So I was asking that, in this case, do you have to find 10% of that 20,000, or you have to adjust the 20,000 with the positive figures there, that is 40 and a 50? Then
you don't find, it is not 10% of the divisions or the segments issue. It is the 10% of the total assets of the entire entity or total value of the entire entity. So 10% is not about the specific division. That is why we are doing the division over total. The division over total. That's how we deal with. That's how we deal with operating segments. So it's the division over the total, not 10% of the divisions. No, you don't do that.
okay, then with the presentation on financial ratio analysis, you made mention that you have to start with your, maybe if it is a report or memo, you have your to, from, subject, and a date. You should have your introduction, which should tell the purpose, the ratios to be used, the basis of comparison, and the year. The body should talk about the interpretation of the, but I feel like when you go to the body, you write financial performance. So I was asking that, if I get to my body, can I classify those ratios? Let's say maybe, can I use maybe profitability ratio, liquidity ratio, and that in order to explain?
That's what we said there.
Okay.
So it's not that you write heading body. Nah.
No.
After your introduction, financial performance, you are using profitability ratios. So if you say profitability ratios of financial performance, no problem. Then your next paragraph, liquidity, working capital, the next paragraph, gearing, whatever, then you go away.
Okay. Thank you.
Right. So that is it about that. And if there are no other questions, just a final thought, then we move away from here, leave you to go and do your things. Like I mentioned to you, we said that as you go to the exam hall, you're looking for easy marks. This is not where you flex your muscles. This is not where you do guy. You're not there to please anybody. You are there to get the marks and pass the exams easily. So number one, you want to take out your ethics. 5 or 6 marks question is going to be on ethics. You're going to take it out. It's not miracle. You can read the question, identify the ethical issue, link it to the threat that is, identify the threat, link it to the professional ethics that is being breached, and what causes of action has to be taken will be dependent. Will be dependent on the context of the question. Then there will be other theories in the questions that you need to answer. For those of you in corporate reporting, especially, there's going to be a 4 or 5 mark question on consolidation. So we've said, remember to go over the theories on consolidation because one of them will be there that you need to look out for and be mindful of there. Then there will be other theories there on the standards. I've told you there could be theories on the standards. It's very crucial you know about that. So take your ethics, take your standards. We've also spoken about the conceptual framework or regulatory framework that the examiner can bring something about that. Whatever theory that is it that we have, make sure you are familiar with it and take that out as early as possible in your discussion. Like I said, each question should be answered on a fresh page. Each question should be answered on a fresh page. You are not under obligation to answer question in any order. You answer what you can do best first. So if it is question 3B, that has a theory on consolidation that you can answer it. If question 5C has another theory, come to a fresh page and come and answer it. You are not under any obligation to answer questions in any order. If the marker is supposed to mark question 3, is under obligation to go through your script to find wherever the question 3 is and mark all of them. So you're not under obligation to answer questions in any order. If not, you're going to really harm yourself later on in the exam hall. Once you do that, you go to the third category, and that is going to be ratios. Like I said, it's not going to be a miracle. I mean, for those of you who have written ratios and we have marked and shared our thoughts on it, you have improved significantly in your ratio analysis. So as you go into the exam hall, just the same thing that you are going to do in the exam hall, be mindful of your calculations, the various things that has to be taken into consideration. But the interpretation, like I said, for those of you who wrote interpretation, we've discussed it with you and we've shown you how you are supposed to do your interpretation. So you are okay with that. I mean, some of you never wrote anything. So, but we know you know. So as you go in there, what you know, go and write it and make sure you write a good thing. So ratios. Now, those of you in corporate reporting, which spoke about consolidated cash flow analysis as well. And we explained that in class. Again, we asked you guys to write cash flow analysis, but we didn't receive scripts from anybody. We know you know. So when it comes in the exam hall, you write it because we know you know. So you write whatever the examiner will present to you. Then whatever you write it. Hopefully you will be able to get the marks that you are supposed to get. So you go to the ratios. Now, consolidated cash flow, like I said, is for CR students. So that's not for FR people. So your ratios and your calculation or interpretation, very important. And those of you doing corporate reporting, consolidated cash flow is there. We explain the principles. Make sure you understand that. And like I said, the analysis, you're on your own. You know how to do that already. So continue to go and write that if it comes in the exam hall. Then when it comes to the ratio calculation, make sure you pay attention to the question well. If it requires some adjustment that has to be made, remember the examiner can bring some standards here, IFRS, that it would have to adjust the financial statement even before calculating the ratios. So be mindful of that, whatever be the case. If the examiner is generous, he will just give you the ratios, then he will say, write report. Then in that case, he will say, what are the limitations? Remember, there are theories on ratios, limitations, and the importance or objective of ratios. So the examiner can just calculate the ratios and say, write a report, and you go away, 10 marks for the analysis. Yeah, I know some of you are praying for that. But if your English is not good, your interpretation is not good, you can equally get 0 from your interpretation. So whatever be the case, you go in there, you take out your ratios. It's not going to be a miracle. Then you go to the IFRSs. We've mentioned that there is definitely going to be a question on the non-current assets standards. And so you have to be mindful of that as you go into the exam hall, the non-current asset standards. The OG himself, IAS 16, with the connected tissues of IAS 16, IAS 23, IAS 40, IAS 20, IAS 37, IFRS 5. Those non-current asset standards, at least 2 or 3 of them will be featured in the exam hall, and you have to be mindful of that. Those of you in level 3, we've spoken about IFRS 9, IFRS 2, IAS 19, employee benefit. Either 2 of these guys will be in the exam hall, or all the 3 will be in the exam hall, because these are exclusive standards. But we also mentioned that IFRS 8. The examiner hasn't said any question on that. Maybe he would want to share some thought on it. We don't know about that. Then the other standards that you know about, you learn them. You learn them and know them very well as you go ahead. Then for financial reporting students, single entity, whatever the heck is going to be there, we don't know. Cash flow or P&L and position, it's still going to be based on your standards. It's still going to be based on your standards. So once you're strong within your standards, whatever statement the examiner brings, you have to be mindful of it. If it is a cash flow, remember the key workings you are supposed to do. Income tax workings, you will do that. Dividend payment workings, you will do that. You know, all the other workings, PPE workings, you will do that. Whatever the examiner is excited about, he wants to bring, it is his court. He decides what the heck he wants to bring. But cash flow has been something that the examiner has not really shared his thought on over the last examination date. So probably this semester, he will want to flex with you a little bit. If not, he will just go with a single entity P&L and position for you. But all is based on the accounting standards, and you have to be mindful of the various accounting standards there. For those of you doing corporate reporting, you know that the link there is going to be business valuation or financial reorganization, business reconstruction. That is also one of these will be there. Remember, we said when it comes to financial reconstruction questions, you have to always do the capital reduction account, because whether you like it or not, you have to do it. Because that is the account that serves as a control account to enable you to finish up with a reconstruction. So whether you are told to prepare or not, you have to prepare it to complete your double entry. And please be mindful of the English that is available in the question. Then in business valuation, also the various issues that we discussed there, one of these guys will be there. We don't know what the heck is going to be there. The examiner's best friend has been the financial reconstruction, because in corporate reporting, that is what we really do as CFOs and accountants of a firm, enabling the company to restructure. However, business valuation is also another fundamental area. So whichever that is going to be there, don't try to focus. Don't try to say, oh, I'm mastering this. No. Because some of you have decided that there are certain things you're just going to master and you are going to ignore. What if what you master doesn't come? Open your wings and spread your wings over. Then lastly, you go to the consolidated financial statements. That should be your last but one question. Okay. I don't care how you feel you understand consolidation, but my recommendation is that let that be your last but one question. Let that be your last but one question. And you want to go in for your free marks, how to calculate goodwill. No matter the question, you have to calculate goodwill. And it is a calculation that the examiner will shower a lot of blessings on. If he is excited, he will ask you to calculate goodwill for maybe 3 marks, directly bring it in. If he's not, he doesn't do that as part of your consolidated financial statement, there will be a lot of blessings that the examiner will shower on goodwill calculation. And know how to deal with your intragroup trading very well, how to reconcile the current account, how to deal with the issue relating to provision for unrealized profit and all that. Then certainly any other issues that you have to deal with, because depending on the financial statement you are preparing and the workings that you are supposed to do, and we've discussed all of these things already. So that's basically what you have to understand when we talk about financial reporting and corporate reporting. Like I said, answer your ethics, take away your theories as early as possible, answer your ratios. Depending on whatever the heck the examiner brings, you're at a good position to go in there. The standards, they're going to be there. Make sure you're strong in the standards before tomorrow 9 a.m. or before tomorrow 2 p.m. for corporate reporting students. Single entity, don't try to master anything. Make sure you understand the standards and know the workings that must be done if you're doing cash flow or you're doing single entity. Then certainly corporate reporting students, you know what to do there, business valuation, financial reorganization. Then the last thing, consolidation. Like I said, let that be your last but one question. I can guarantee you, if you start with consolidated financial statement, you're going to use like 1.5 hours to do that. And before you know it, you are failing the exams because you're going to start panicking. And when you start panicking, 99.9% of the time, you're going to fail the exams because you're going to freak out. Finally, it's going to be your emotions. You need to ensure that you control yourself in the exam hall. I think I've told you this over and over again, you need to ensure that you really, really control yourself in the exam hall when it comes to dealing with your emotions. I cannot overemphasize the importance of this. So make sure you control your emotions in the exam hall. A lot of things will be happening. That is why you have to take time to read the questions very well. Take time to read the questions very well, and then start with what you can do best first. The trick is that, you see, your mind, you have to lie to your mind. Your mind is like a child. You have to lie to your mind. So you have to let your mind know that, oh, everything is going to be right. Everything is going to be right. The mind is created to shelve you from disaster. So if you start with what you can do best first, you are telling your mind that, oh, it's nice. It's nice. But if you start with a question that freaks you out, the first question freaks you out, 45 minutes and you can't see top, immediately your mind will start saying that all the workings you've done in the last 3 months, it's waste. And immediately your mind starts playing that trick on you. In 45 minutes, you have to take control of your mind and reposition yourself. If not, you will start forgetting everything, because when your mind starts and you start panicking, your blood vessels are going to just be focusing on your heart, pumping blood to your heart, and your heart will be beating like, you've got broken hearts, but you have not gotten broken hearts. I don't know if your heart beats when you get broken hearts, because I don't know about broken hearts. So you just have to control your emotions. That's what I'm trying to say. In the exam hall, you want to control your emotions and ensure that if you are freaking out, make sure you take control of the situations as fast as possible. Get up, go sip some water, and come back, sit down, and continue to work. Continue to work. Your emotions will play a trick on you a lot, but make sure you are staying guard on it and stay clear. Once you do that, I think you should be good in the exam hall. So do not panic. Do what you have to do. You've been told whatever it is you have to focus on. You've been provided with the guidelines that you have to know about. Go in there, do what you have to do, and make sure you pass the exams. Like I said, read all the 5 questions carefully and start with what you can do best first. Sometimes somebody once told me that, oh, I saw the consolidated question and I realized that I could do it because there are a lot of notes in it. So I did the consolidation first. My recommendation is that should be your last but one question. But maybe you go to the exam hall and you read the consolidation and realize that, oh, it's a simple consolidation. It doesn't have a lot of notes. It doesn't have a lot of miracles. Then you could do it and start with it. It's your swag. It's your call. My concern is you make sure you discipline yourself and manage your time very well for that. So that is basically about that and what you need to do as you go in the exam hall. And we hope that you'll be able to make yourself proud and pass the exams. My concern is only on your time as well as your write-up. Your time as well as your write-up, because some of you, your grammar is it's not good. It's not that you don't, you don't understand English. You don't know how to speak. What you speak is different from what you write. So my fear is some of you, your grammar, some of you, your English, some of you to have never marked your work. So I don't even know if you have any grammar to write or you don't have grammar to write. But be mindful of what you are writing. Stay within the scope of the question and be direct. Don't just regurgitate points, especially in the ratios. Don't come and tell us, don't tell the examiner, oh, the ratio has risen from 30% to 45% as indicated in the appendix. And so what? Give us the reasons. And we've given you the guidelines on how you interpret each of these ratios. So be mindful of that. For corporate reporting students, if consolidated cash flow analysis is what the examiner is bringing or will bring, know how we gave you guidelines on the analysis. And like I said, for those of you who wrote, nobody wrote that. So I don't know. I know you know. So when you get to the exam, I'll just do what you know best and you should be okay on that case. So that's it about that. And we're going to leave you here. We wish you all the best. And we hope that you'll be able to sail through and pass the examination. And we will see those of you who will be at graduation. We'll see you at graduation. And those of you who are in level 2 that will have to shift to level 3 also, we will see you some other time in that. So that's it about that. And we're going to end today here. And like I said, from now till 9 a.m. tomorrow, CR student, if there are any things, you can send me a message on WhatsApp about it. And I can check for you. The corporate reporting students also from now till, 2 p.m. tomorrow, as your paper is going to be. If there are anything, you can send it to me on WhatsApp or something like that. And I'll be able to provide you with any assistance that you need for that. So that's it. All the best.